The global market moves like a living organism, breathing with every economic data release, political statement, and investor emotion, and at the heart of this movement, the stock market and gold price share a deep, dramatic relationship that shapes wealth, fear, and opportunity across the world. Every morning, when Asian markets open, traders already carry the weight of what happened overnight in the US, how Wall Street reacted to inflation numbers, interest rate decisions, or geopolitical tensions, and this ripple quickly reaches Europe and then circles back again to America, creating a non-stop cycle of expectations and reactions. In this vast system, the stock market represents growth, risk, ambition, and belief in the future, while gold stands quietly as the ultimate symbol of safety, trust, and timeless value. When confidence is high, companies post strong earnings, interest rates are stable, and investors feel optimistic. Money flows aggressively into stocks, pushing indices higher and often putting pressure on gold prices as investors move away from safe assets. But the moment uncertainty enters the picture, whether through rising inflation, war, banking crises, or recession fears, the story flips. Stock markets turn volatile, and gold suddenly shines brighter as investors rush to protect their capital. The price of gold is not just a number on a screen, it is a reflection of global fear, currency strength, and central bank policy, especially the decisions made by the U.S. Federal Reserve, because gold is priced in US dollars and reacts sharply to changes in interest rates. When interest rates rise, holding gold becomes less attractive because gold does not generate interest, leading to downward pressure on prices. But when rates are cut or expected to fall, gold often rallies as investors seek protection against inflation and currency devaluation. The stock market, on the other hand, reacts differently, as lower interest rates reduce borrowing costs for companies, increase liquidity, and often fuel stock rallies, creating an interesting tug of war between equities and gold. Global events amplify this relationship even further, as conflicts in oil producing regions drive inflation concerns, weakening currencies and strengthening gold. While technology booms, strong consumer demand and government stimulus packages lift stock markets and reduce the appeal of traditional safe havens. Central banks around the world play a crucial role in this balance, as many countries actively buy gold to diversify reserves and reduce dependence on the US dollar, a trend that has provided long-term support to gold prices even during periods of strong stock market performance. At the same time, stock markets reflect not just economic reality, but also future expectations, pricing in growth years ahead, which makes them highly sensitive to guidance from policymakers, corporate earnings forecasts, and global trade dynamics. For investors, understanding the gold rate is not only about tracking daily price movements but about reading the deeper signals it sends about global liquidity, inflation expectations, and systemic risk. While watching stock indices reveals how confident the world is about growth, innovation, and stability. During times of crisis, such as financial meltdowns or pandemics, gold often acts as insurance, rising sharply as stock markets crash. But during recovery phases, equities tend to outperform as capital shifts back toward risk and expansion. This constant rotation between gold and stocks is driven by psychology as much as by fundamentals, because markets are ultimately powered by human behavior, fear of loss, and desire for gain. Long-term investors often use gold as a hedge within diversified portfolios, balancing volatility from equities, while traders watch short-term correlations to capture opportunities created by sudden news or policy shifts. In emerging markets, gold also carries cultural and emotional value, adding another layer to demand that is independent of stock market performance, especially during periods of currency weakness or political uncertainty. The global market today is faster, more connected, and more reactive than ever before, with information traveling instantly and capital moving across borders in seconds, making both the stock market and gold price highly sensitive to even a single comment from a central banker or a surprise economic report. For anyone watching or participating in these markets, the key lesson is that gold and stocks are not enemies but partners in understanding the bigger picture, each telling a different side of the same global story. Stocks tell us how confident the world feels about growth and innovation, while gold tells us how worried it is about stability and trust in money itself. By observing both together, investors gain a clearer view of where the global market is heading, what risks are rising beneath the surface, and where opportunities may emerge in times of calm or chaos. In the end, the dance between the global stock market and the gold rate is a powerful narrative of human confidence and caution, constantly evolving, endlessly fascinating, and central to the financial heartbeat of the world.